Hi everyone, welcome to another reading group session here with Hudson and Sams. Today we're going to be talking about meta-labeling, the theory and framework. This was a concept that I think has garnered a lot of attention by the financial machine learning community. And it originally came out in a book by Marcus Lopez de Prada called Advances in Financial Machine Learning. I'm jumping a little bit ahead. I'm going to introduce it now in a second and why it's such a cool idea. But one of the things we did when we started this year is we said to ourselves, there were 4 papers that we wanted to publish this year in peer-reviewed journals. And so meta-labeling is a really cool idea because there are no, to my knowledge, there are no peer-reviewed and published papers on this. There are lots of there are a couple of master students that have used this as a topic in their master's theses, but none of those papers have been published in peer-reviewed journals. And so we thought, hey, it's such a cool idea. And it's something that really resonated with me back in 2018 when I read the book for the first time. But the book is a hard read. You really have to go through it in detail. You have to have a really good background. You kind of need, to have some history in machine learning and in finance and econometrics. And I remember reading chapter 3 about meta labeling. There's about two pages on the topic, and then there are 34 references in the bibliography section of that chapter, and I had to read every single one of those papers to try to figure out how Lopez de Prada came up with the what was the inspiration for the idea. So that's a bit of a tough cookie to crack. And so I think lots of people had questions about meta labeling and how it works, and is it the same as ensemble learning, and why are we doing things in this way? And some of the things are quite counterintuitive. And so when we set out for this paper that we wanted to publish, we wanted to create a landmark paper that everyone else had to reference going forward that then built on meta labeling. And so we really dived into the theory. We really thought carefully about how does this model work, where does it add value, what are potential mistakes or concerns that we can address, how is it different to ensemble learning. So we came up with this paper, Meta Labeling, Theory and Framework, and that's exactly what it does. Michal and I also wrote a paper with Messias Alpheus, who is a professor at the University of Stellenbosch. And the 3 of us then published the follow-on paper, which was Architectures for Meta Labeling, and that was all about new architecture. So I'm gonna present an architecture today, but it's just one of many architectures that you could develop. And then we have 2 more papers that are upcoming. So one is then about focusing on the position sizing component of meta labeling and what kind of really cool algorithms can we use for that. And then the 4th and final paper for it is how we can use ensemble learning in meta labeling, and a particular type of architecture there. So those 2 papers are still going to come out. We can always, if you guys really like this topic of meta labeling, next week we can dive into Michal's paper with the architectures and a way to think about it. Or we'll vote at the end of the session. All right. So the framework I'm going to follow in this lecture, we're going to go over kind of the problem of non-stationarity in financial time series and why it's a problem. We're going to discuss a solution for that, which we believe meta labeling solves that problem quite well. We'll briefly cover classification metrics, discuss the strategy risk template. So that's quite a cool idea, is that we can, sorry, I'm just letting Proton in. We can identify, before applying meta labeling, we can identify if applying meta labeling will add value to an investment strategy. And so that, that strategy risk template will tell us, will it make a big impact or will it make a small impact? If it makes a big impact, that's really encouraging for saying, hey, go forth and add a meta labeling methodology to this investment strategy. We'll discuss model architecture, the experiments that we ran and why we ran those experiments, the results, and then kind of the further areas for research. Now, I've given this lecture before. I originally gave it at the Thalassians meetup here in London. There is a recording for that online. Alex Proskurin, the other co-founder at Hudson Thames, has also discussed this at a meetup. I think it was a Ukrainian meetup for machine learning. You'll also find a recording of that online, but hopefully, since I'm the original author on this, I can really dive into some questions that people may have here in the audience and fill in some blanks. I will also, so the paper is published, and it's published in the Journal of Financial Data Science, which is a really respected journal. I would say it's the very best journal for financial machine learning, but that's our opinion. And the problem is that they own all the copyright, so I can't share the paper with anyone. But I can show you highlights from the paper, and obviously I can discuss everything, in this presentation. So jumping in, first of all, we'll be talking about the problem of non-stationarity, and what is the problem we have with training models in financial machine learning. And so the biggest problem of all is that the data generating process that explains how the data is created changes through time. All right, and this is due to a whole number of reasons that I'm going to cover in the next slide. And so what does it mean that this data generating process is changing through time? Well, that literally means that the equation, kind of like the functional form, is changing. And so one way we can see this is that if we look at different distributions of our data, we'll find that the data kind of shifts through time. And so this was a great slide that a friend of mine created for another presentation, Stuart Reed. Him and I used to work at a fund called Numerical. And he created this slide here. And so he was showing, this problem of non-stationarity of these three different distributions. And you can see kind of how the means are shifting, how, the tails, kind of like the kurtosis changes all across time. And he shows kind of, at T, it looks like this, T plus 1, and then T plus 2, it looks like this, right? Like you can't train models where the data is changing through time. If you train it using like a train test split or cross-validation, the assumption in all machine learning models is that your data is stationary. And for most machine learning models, that your data is also IID, right? That it's independent and identically distributed, that one observation is not dependent on another observation. And so for time series model, this is already a violation, because the next observation is often, dependent on the previous observations. And that's where we're going to see these autoregressive models, ARIMA-Gotch type models that we see in econometrics. They kind of solve for that. But when you're doing financial machine learning, you're probably trying things like SVMs, random forests, even like feed-forward neural networks, and they all assume that your data is IID, right? That your data generation process is not changing, and that each observation is independent, which is not true, right? And these are the things that make financial machine learning difficult. And so jumping to the next slide, let's have a look at some of the things, you may hear people talk about. And what they're really saying is that the data is non-stationary, right? And so you may already hear people talking about different regimes. If you watch the news on TV, they'll say, oh, we're in a high volatility regime. Vol is really high. There's a lot of uncertainty. That might be one type of regime. Another type is, you may have trending or mean reversion. The data generated process could be a random walk, i.e. there's no information in the data and no forecasting model will do well in predicting what's going to happen. During recessions, we have high volatility and we see markets crash really quickly as people have panic selling. We can see that over here. So if I show you over here for the 2008 financial crisis, we see this huge drop in performance over here. This is very normal for kind of like panic selling. And so we may, be able to cluster these relationships and say, hey, can we look at different regimes where we can say, just look at panic selling or just look at bull markets with low volatility. And what we're going to find is that different trading strategies perform differently given the regime that we're in. And the toy example that I always give is a trend following strategy. So, I'm not a big fan of technical analysis. That doesn't mean it doesn't work. I just am, I have my own reasons for why I don't like it. But the toy example is a moving average crossover strategy, right? And so in that strategy, we have two moving averages built on the price data. One is a slow moving average, so let's say a 250-day moving average, and the other one is a fast moving day average. It could be a 50-day or a 25-day moving average. And so when the fast moving average crosses above the moving average, that would indicate that there is kind of like momentum in the data and that you should take a long position. Conversely, if the fast crosses below the slow, that would signal a sell position. And so if you build that type of trading strategy, which is a momentum trading strategy, or it could be considered trend following, you'll find that it doesn't perform when markets are highly volatile and markets are going sideways. And so one of the things and the benefits that I'm going to introduce in a second with meta labeling is that it helps us to identify when a strategy, like given a market regime, when will a strategy perform well? And if you're in a regime that is known that the strategy underperforms, just switch your model off. And that's exactly the kind of mechanism we're going to try to solve for in meta labeling. I highlighted here. So this was, I think these were slides that I got from, these two images. This image here at the bottom, I think, is from a k-means clustering algorithm applied to their this ticker. I think it's the S&P 500, from a blog post on Michael Horsmore's blog. Start, I think is his blog's name. And so here they were just using k-means clustering on, say volatility and mean. And you can see here, the different types of regimes that this algorithm kind of created. And there's lots of different ways to do this. But again, I'm just highlighting that there are different regimes. The markets go through different environments. And so this can also be due to like structural changes, right? Markets have evolved from an open outcry system where we had stockbrokers, shouting with all these weird sign language symbols to like buy and sell in an open outcry system. And then we moved to electronic trading. So, moving away from that outcry environment more to sitting at a desk trading. And then there was the introduction of high frequency trading, right? And so, like optimal execution algorithms and even some predatory algorithms. And so you can really imagine kind of how the way in which we traded has changed. Sometimes laws come into place that change the way we can trade. Things like, you may not short on a downtick. So you can only short on an uptick. You can only open up a short position if the market has ticked up. These types of regulations, they really change the way in which markets behave. And so these are part of the reasons why we can say, the data generating function is changing through time. Over here in this plot on the right, I'm showing daily percentage changes of an asset. I think it was the S&P 500. But the thing I want to show you is this volatility clustering we see here, right? This kind of heteroscedasticity in the data, that when volatility spikes, it's likely that your next observation is also going to be, if you're in a high vol environment, you're probably going to stay in a high vol environment. If you're in a low vol environment, you're probably going to stay in a low vol environment. And so we see this volatility clustering kind of effect we see here. This also makes it really difficult for forecasting. And so there is a YouTube video we have about what makes forecasting financial time series very difficult. And in there we list a whole bunch of landmark papers, and there is a paper that will reference how volatility clustering heteroscedasticity causes problems. Right. So the solution we're proposing, the solution Marcus Lopez de Prada is proposing for this, is to use a technique called meta-labeling. Now, meta-labeling, it is not an algorithm, but rather a way of work. And that's a nice way to think about it. I think it would be particularly difficult to build kind of like one end-to-end solution that would work for all types of models. You need to rather think of it as like a way of work and a technique that you apply to different trading strategies. And so what it is it's a machine learning layer that sits on top of any base primary strategy. And so a primary strategy could be a momentum, it could be technical trading rules. So you could say something like, I don't know, the moving average crossover, or if this RSI indicator is in a certain range, then buy or sell. It could be a fundamental based strategy. You could say, well, I'm going to trade different, I'm looking at the supply of gas in Europe versus the supply of gas in the UK, and I'm going to take a position based on that. It could even be discretionary fund managers, but you would need data to track their, for example, I don't know, heart rate. Are they getting divorced? Are they going through a stressful event? But the core idea is that meta-labeling is a machine learning layer that sits on top of any base primary strategy, and its goal is to help size positions, filter out false positive signals, and by doing so, it allows us to improve the performance metrics of our trading strategy, such as increasing the Sharpe ratio and reducing maximum drawdown or even average drawdowns. That's what this algorithm is promising to do. And so this highlights the need to separate your side forecast from your size forecast. Now, you guys remember last week when we were doing, so not last week, but the week before, when we did deep momentum networks from the Oxford Man Research Group, and we were talking about how they were taking an alternative approach where they were having one model that learned both the side mechanism, which was, is there a trend and the quality of that trend, as well as the market state. And then their algorithm was also, doing bull targeting, sizing the position, and optimizing for Sharpe ratio. This is a different approach. We're advocating, and meta-labeling is advocating for separating your side from your size. So your primary model is going to generate the side forecast, whether you should go long or short, and the meta-labeling is going to determine the size of that position. And that's really important, right? Because if you go really big position sizes on, trades that only make a little bit of money, but then, if you decide to take a trade and you put a massive position size on and that trade loses money versus, I guess what I'm trying to communicate is the size of your position can make you go bankrupt if you apply it wrong, even if your side forecast is correct. So if you size very large positions that lose money and you size very small positions that gain money, your expected gain from a trade is going to be skewed to the losses, and so you can go bankrupt on that. And so it's very important to get the sizing component right. Now we're going to talk about classification metrics. If you are like us, you've read a lot of machine learning papers in finance, and what you're going to find is many of them focus on a classification setting, typically a binary classification. Is the market going to go up or down tomorrow? It could be in the next week or the next month, and that is because binary classification just gives us such better information than we see from a regression. So in a regression, we'll focus on something like mean squared error, but that doesn't tell us. I mean, one thing we can do with classification is we can say, okay, well, we predicted that the market was going to go up, but it didn't go up, right? And so we can learn a lot more about these classification metrics, which give us information such as precision, recall, F1, and the actual confusion matrix. And there's a lot of insights we can derive from that. Now, you can apply these to a regression, but that's kind of applying a classification overlay on top of a regression in order to pull this information out. And also, it's a little bit easier if all you're trying to do is forecast, is something going to move up or down, as opposed to, or, is it going to hit its take profit level or stop loss level, rather than trying to forecast, for example, in a regression setting, you may get the direction right, but how far you are from the actual value, you'll still get penalized on that, right? And so one thing that is going to come up is that if you get the direction of your trade wrong, that's when you actually lose money. And so this is also, again, why you've seen classification settings come up a lot in financial machine learning. Now, this lecture is not nearly long enough for us to really dive into exactly, what a confusion matrix is, and this the classification report, which gives us the precision and recall. I would say, if you don't understand what these are, go check it out on Wikipedia, go read more about it, understand it, and then, come back to this lecture. At the end, I can open up for questions, and I can answer any questions anyone has about classification metrics. But the core thing you need to understand is that the main metric we're caring about is precision, right? So I'll just quickly explain precision and recall. So if we think of people with cancer, right, and we're simply classifying, does someone have cancer or do they not have cancer? And we're using that information to treat them for cancer, right? And so we'll say that recall is how many of the people in our population that actually have cancer, okay, were we able to classify, like, did we mark as saying has cancer, right? So if you have a recall of 80% or 86%, that means that we got 86% of the people who have cancer, we said, may have cancer. The problem with this is that there are, what is that? 86 minus 1, 14%, like 14% of people we're classifying as don't have cancer, but they have cancer, right? So they're not going for treatment and, inevitably die, which is quite serious. Now, precision is another metric where it is, okay, you said someone has cancer, but how many people in that population actually have cancer? Now, this is an important metric because, if you say someone has cancer and they don't have cancer, you would take them for like invasive treatments such as surgery or chemotherapy, and well, they don't have cancer, and so that's just very destructive to their cells in their body, and that opens you up to being sued and things like that. And so in trading, what we really care about is precision. So if we said you should take a trade, what is the likelihood of that trade being profitable, right? We only lose money on the trades that we take, and so you're not actually going to focus on accuracy. You're going to focus on precision. That's really the metric we care about. And so meta labeling introduces this concept. And so I just want to check. Yes. So it has this concept of, so you've got the secondary model that filters out bad trades from a primary strategy. The target variable in this secondary model are what we call meta labels. So a meta label, so the primary model, and we're going to get to this in a second, but the primary model generates a side forecast, 1 for long minus 1 for short, right? Then we take that and we say, hey, you said go long. Did you actually make money? Was this trade profitable? If this trade was profitable, then the meta label will be 1 to indicate, yes, it was profitable. If it's not profitable, the meta label will be 0. And so the meta labels simply indicate if a trading strategy would make money or not on that trade that it took. Let's jump into rather a primary models architecture, right? So you can think of this as any trading strategy. It could be, I see Melinda's here, let me align them. It could be any trading strategy, right? So let's say this is a technical trading strategy. It's a moving average crossover strategy, right? And so that's what this primary model is. It takes in some features which are, in case of a moving average crossover, it would be a time series of price data which is used to create the moving averages, and then the moving averages generate a trade up to -1 to go short and 1 to go long. Okay, and that's what the output of that model is. Then we need to understand that this model has evaluation data, and so this could be considered as the rolling accuracy, precision, recall. It could be like rolling entropy. You can apply like information related like algorithms like mutual information, correlation, things like that. You can apply to these evaluation data that's coming out of this model as well. Then once we've got this, we must remember that, so let's say, for example, we're using a neural network with one node in the hidden layer. It's got a tan-H activation function, so the output is going to be a value between -1 and 1. So it's going to, in this case, it's a long-short strategy. And then what we can say is, okay, well, actually, I'm going to take a step back. So let's say we're doing a logistic regression, a long-only strategy, and it's only going to be, this output is going to be 0 and 1. Okay, 1 indicating go long, and 0 being go short. Now with a logistic regression, any value greater than 0.5 that it spits out, so it's going to be a real value between, see Melinda's struggling to get in, I'm letting me know. It's going to be a real value between 0 and 1. Okay, any value less than 0.5 is going to indicate a short position, or don't trade, and a value greater than 0.5 is going to indicate you should go long, take a position. And so we can add a threshold, and we can say, hey, the output of this model was, say, 0.56. And so we can say, okay, well, I only want you to take a long position if you're greater than, say, 0.6. And so you can add a recall check. And then, the final output, in our case, is just going to be 0 or 1. But in the case of a short and a long, that would be -1, 0, and 1. One of the things I wanted to show for this recall check and why it's important is because this is actually a section from our paper. And one of the things you can see here is that what we did is we plotted, how the Sharpe ratio and the mean returns of a strategy changed as we adjusted this threshold, right? So the default threshold in a logistic regression is 0.5. So it's going to be these values here, right? But you can see that as we move the threshold up to 0.6, our Sharpe ratio goes up. Of course, in this case, the mean returns goes down, but as the mean returns goes down, the variance is going down more. And so because of that, we're actually getting a positive trade-off where the Sharpe ratio is greater. And this is a little counterintuitive. For many people, they don't realize that you need to adjust that threshold to get the optimal kind of, Sharpe ratio, whatever metric you're trying to optimize for. Maybe you don't care about stability. Maybe you just care about maximal returns, in which case, you'd want to even reduce it less than 0.5. We see here, let's say at 0.8, we see you get the maximum return. And so this is why changing that threshold is important. If you do have access to this paper, all the details are in the paper, and you can read everything there. I'm just highlighting the need for this recall check.
Hey, hi. I'm sorry, joined late. Anyways, I just wanted to know, the adjustment of the threshold, right? Is it done on the validation data, out of sample data, or?
No, you did in sample, right? Because you can't change something on the out of sample data, because then we start overfitting.
Okay. So, so when you're adjusting the threshold from 0.5 to 0.6, essentially what you are the Sharpe ratio or the mean returns that are being observed here are on the validation data, right? That's not on the training data.
I mean, I would do it on the training data. You don't
Okay.
want to change stuff based on validation data or test data, right? That's how we overfit. So you want to say, hey, on our in-sample data, this is, what the Sharpe ratio would have been at this level. And if we change the threshold, how would that Sharpe ratio have changed in sample? That's how I would do it.
Okay, understood.
Now we're going to apply meta labeling. So we've got this base primary strategy. In our case, we're going to do a long only strategy. So 0 and 1 for the side forecast. And we come down to, up now the secondary model. So we're talking about meta labeling. And I think the thing that makes meta labeling a little confusing is that the target variable in the secondary model is they are called meta labels, right? They are labels which tell us if the primary model made money or not. And I don't think we should call the secondary model the meta model because there's different architectures which are highlighted in Mikhail's paper. And so, for that reason, I think we should stick to the notation that there's a secondary model. It uses meta labels as the target variable, and this whole way of work of applying a secondary model to filter out false positives is called meta labeling. And so here we're looking at a secondary model to filter out false positives, right? So here we've got a secondary model. It could be anything. It could be a SVM, a random forest, decision tree, an ensemble architecture, anything. And so its outputs are the meta labels. So those labels are between 0 and 1. Harshvardhan, you have a question?
Yeah, sorry to interrupt your flow, but I just wanted to check one thing you mentioned at the beginning of the lecture.
Mm-hmm.
You said for models like random forest, SVM, they have an assumption of stationarity.
Yes.
Right. So if we don't have stationary data at the input of the primary model, would we want to change some of the data and include stationary features if we're using models like those in the secondary model?
So remember, the whole idea of meta labeling is that we want to correct for the problem of non-stationarity. We want to have a secondary machine learning model that looks at when you want to take a trade and it says, you said go long here, but I'm looking at the market state and I see there's a lot of volatility and there's no trend. And I know from historic data that this strategy does not make money during those environments. And so it will downweight the position. And so that's how we're going to adjust for non-stationarity. Like, we know that there is a problem of non-stationarity. I don't know of any good ways to correct for this. One thing that Alex and I quite agree on with our hypothesis of building strategies is that you don't want to build a strategy where you're forecasting every single day, what the direction will be of the next day, because there are so many things that, let's take gas prices, for example, right? So many things that influence the price of gas, right? There are the other energy commodities, such as, what the power price is, renewables, how much wind is there in the air, what the price of, heating oil is, or coal. And so there are so many factors that can influence the price. And so it's really hard to forecast if you're forecasting every single day. But if instead you said, okay, well, I'm only going to focus on, say, there's a nuclear power outage, they're repairing an unexpectedly, they're repairing, 2 nuclear power stations. Every time this event occurs, how does prices evolve over the next 24 hours? Well, a way you can think about it is, I'm only going to look at better than expected earnings announcements on equities, and then try to forecast, how the stock price will evolve, given it better than expected. And so when you do that, then your data becomes a lot more IID, in that at least now an observation is more independent because there won't be a lot of overlapping samples. So that's something we quite like to do. And also that, I don't know if it's expressly mentioned in advances in financial machine learning, but that problem of overlapping samples, I think, is in chapter 4. And so
right.
That's something you can do to help correct for it. But the whole idea of meta labeling is we're trying to solve for the problem of non-stationarity. So we don't necessarily need to add specific features that you think are more stationary.
Right, got it. I thought maybe we could add something like fractionally differentiated time series or something like that that would inherently take out some of the non-stationarity. But I understand that this attempts to correct it. So maybe that's another approach.
Yeah, with the fractionally differentiated features, I don't think it corrects for non-stationarity. It just allows for memory and stationarity. And so when they're talking about stationarity in the data, they're referring to like how stationarity is referred to in econometrics, right? That your data doesn't have like a mean, I mean, there's a formal definition for stationarity in econometrics. I don't remember off the top of my head. So what they mean is like, usually to remove the trend component and the seasonality component, you take the first order difference in price, and then you plot that. And then we can start fitting a REMA and AR models to that, and that data they call weak form stationarity. And so there's weak form, mild form, and strong form stationarity, and certain mathematical rules that apply to that. But when I'm talking about stationarity, I'm talking about that the data generating process is not changing through time. So I guess there's a slight distinction between those two.
Got it. Thank you for pointing it out.
Cool. All right. So coming back to this, the secondary model architecture, right? So this secondary model is going to take in a whole bunch of different data, right? So it can take the original input data that we had from the primary model. So if I go back here, we'll see here's the original input data. So that could be features which were informative for the primary model to come up with a side forecast, right? It could be fundamental data about supply and demand dynamics, anything like that, right? So we're going to pass through that input data. Plus, we're going to pass through the evaluation data. And we said that the evaluation data was the data representing how well the primary model is its recent performance. Like, what is its rolling accuracy, recall, precision? We can do like mutual information and things like that on it. And then, entropy. And then we're going to have market state and regime data. And so Mikhail's paper talks a lot more about this, about market state features. So we can think of market state features perhaps as like, if we have a look at the last 50 days and we would say, hey, what are the last, 4 moments of that distribution? So what is the mean, the variance, the skew, and kurtosis of that distribution? And we could use that as a feature, as a market state. And then regime data would probably be things like, how much volatility is in your time series. Oh, no, sorry, that would be a market state statistic. A regime data would be, it could be maybe more economics related data, like, I don't know, job losses or consumer sentiment. There's a whole bunch of different like long-term economic indicators you can get that would represent. Market regimes, if you read the literature, it usually speaks to, they are slow moving, they last for long periods of time. And so that's going to be our regime data. And then we could also pass through the primary model's initial output, right? So this is going to be a value in our case between 0 and 1 for a long-only strategy. And that would tell the secondary model also like a measure of confidence, like how confident is the primary model that this is going to be a positive trade or in the side that it's forecasting. Now, this is only going to be true if you're applying other machine learning models. If you're using a trading rule, you probably can't pass this through unless you do, maybe, you've created some continuous variable for your output, like, I don't know, quality of the trend that you could also pass through here to the secondary model. Then we've got the meta labels, which, what we use as training. And then once, the model is going to make a forecast, what is the likelihood of success that a trade is going to make money? And then given that output, we can take two approaches. Either we can apply a bet sizing algorithm, which we term M3, and this is really what our third paper focuses on. So you can think of this could be the Kelly criterion, or you could have, I don't know, risk constrained budgeting, some kind of algorithm from there to determine an optimal bet size. Maybe you want to like minimize drawdowns, and then you'd have your final output, right, which is going to be how much of your portfolio to invest in a particular trade. Alternatively, we could also apply a threshold to this. So if this output is, say, 0.55, we may say, no, I only want to take trades which have a threshold greater than 0.6, for example. And then our final output, again, is going to be the position size. Everyone understand that? Can I move on? All right. And so let's talk about the experiment that we set up. So when we were thinking about, okay, now how can we prove many of the things that Lopez de Prado was talking about in the book? Because he says these statements, and he says it very eloquently in these very short one-liners, and they're extremely like information dense. But if you're not super familiar with why he's doing something, or you deeply understand the math of a technique, I I think some of those comments could go over your head. And so when we were thinking about an experiment which could really show the value of meta labeling, we didn't want to use a real trading strategy on real data, because real financial time series data is really hard to forecast, and there's a lot of things going on in there, and we don't fully understand the data generating process. So instead we said, you know what, we would just want to show, at least, in principle through simulation, that meta labeling behaves, based on, the notes that Lopez de Prado mentions in the book. And so we said, okay, you know what, let's use a autoregressive of order 3 process. And so the equation for that is here at the top. It's basically like a multivariate linear regression, right? And we're saying that the next day's return is going to be a drift component plus, some value times the previous day's return plus, the day before that, and we're only going back 3 days. So we're using the last 3 lags to create the next forecast. And so we use this equation to generate the next data point. Okay. We create 1,000 trials, so 1,000 independent time series using this equation, and each of those time series has 10,000 observations in it, right? So we really wanted to see, given a data generating process, running lots of different return profiles, how did this behave? So it's a controlled experiment. There's many realized paths. And so the target variable in this setting for our secondary model is going to be the meta labels. And the primary model that we're going to use is inspired by a book. And I'll pull the book out. I've got it right here. It's called Systematic Trading in Energy Markets. And this was a book I used a lot when I was working in energy. It's a really nice book. It gives you kind of like the introduction to a couple of cool ideas you can try out. But in the book, they talk about a German power strategy where they basically say, hey, if yesterday's, if the power contracts, if they increased in price yesterday, go long today. If they went down, go short today. It sounds super stupid, but go try it out. Go build that in a backtest. You're going to see it has pretty good performance. And so the economic rationale behind that is that, there's less liquidity in energy markets. You have these massive players that need to like hedge and buy large contracts, and they can't buy everything they need in one day. And so they kind of have, their positions rolling over multiple days to get that execution on a market that's quite sensitive due to low volumes. And so it makes money. And so we said, okay, that was the inspiration. And so the primary model that we're going to use is basically saying, hey, if the previous day's return was up, forecast up. If the previous day's return was down, forecast down. And then we're going to, through meta labeling, apply 2 different position sizing techniques, an all or nothing approach, which is saying, hey, if you said, if it's going to make money, then go 100% invested, otherwise don't. And then the other technique, which is, we just basically apply an empirical cumulative distribution function to the payouts in our training data. I'm not going to talk too much about this. You can read more about it in the paper. I try not to complicate this with too much math, but I just want to highlight here in the experiment, right? So the reason we picked this is we know a couple of things about the data, okay? We know that the primary model is suboptimally using the information in the data. We know that the primary model is only using this part here. It's only using, hey, if the previous day's return was up, go up, right? It's not exploiting all the valuable information over here, as well as this drift component, right? And so through meta labeling, we're going to see that we're able to better exploit the information in the data. And we call that the information advantage. And so I'm going to skip over a few, and I'm going to get to this plot over here. So we ran these experiments, and we saw how meta labeling performed, and we plotted. And so one of the things we thought carefully about, and this is a novel contribution, is that meta labeling can be broken up into 3 parts of where it adds value, okay, where it improves the strategy. So the first is what we call the information advantage, and that is the outperformance on your performance metrics, your strategy performance metrics, which relate to using the exact same data that was used to train the primary model in the secondary model. And that relates to just the secondary model is better able to exploit the information in the data than the primary model. And a really simple example of this, we look at our experiment and we see that our primary model only used the previous day's return, where our secondary model, exploited, the last 3 days returns. And so it just was able to use the information better. And so that's what we call the information advantage. Then the modeling for false positives is the part of meta labeling that has more outperformance, which is related to the features you use, which would be indicative of a false positive, of that a trade would not make money. And so that could be like volatility, and was there a trend? It could be certain economic variables, like macroeconomic variables. And then the last one is position sizing. So that is okay. And now if we apply a special algorithm, the M3 algorithm we see over here, we're also able to squeeze out additional alpha and better performance metrics by using a special type of algorithm here. And so I'm going to jump to here, and this is what we see here, right? And so we're looking at 4 different performance metrics. We're looking at the Sharpe ratio, the maximum drawdown, the mean returns, and the standard deviation. Okay, and then we go through 4 different phases. So we have what's called the buy and hold strategy. So this is just looking at, hey, if you bought and hold this the series that we generated, what would your Sharpe ratio have been? And we can see in these box plots that, yeah, your Sharpe ratio is really close to 0 because it's pretty random. And we can see this somewhat of a variance around this. Then we see the primary model that we applied. It does have alpha, and we do see that the median value over here is higher than the buy and hold. We do see that it does make money. And then we see that, okay, when we apply just the information advantage, we see a jump again. We see that, yes, meta labeling is better able to exploit the data. Then we add features which are indicative of false positives. We see a massive jump over here. And then again, we see that when we apply a bet sizing algorithm, it jumps again. So here we can see gradually, yeah, meta labeling is improving the Sharpe ratio as we go through the experiments. We can see here on the drawdowns, this for me was very interesting because this was not something that was written about in Advances of Financial Machine Learning. It's something we discovered, we just had the idea that, hey, let's have a look more holistically at all the performance metrics and get a feel for what's happening. And what we saw was, you can see here, as we run through the different experiments, we can see how the maximum drawdown, on the buy and hold, it can go up to, 80% of your portfolio. More than 80% of your portfolio is the median value of like how much money you would lose, in a max drawdown. And we see how this kind of like improves. And basically, when we get here to the sizing, we see that our drawdowns, I think over here, it's like 5% is the median value. That's our maximum drawdown, is that 5% is all we lost. And so that was just really exciting for us to see. One of the things we can see here on the mean returns is that we kind of see the mean returns going up, but we see mean returns coming down when we use a sizing algorithm. But we do see that the standard deviation comes down. And so, yes, we are getting a lower expected return over here, but our variance is dropping a lot. And so that means we get better Sharpe ratio and less drawdowns. So this is just showing the results really of us running the experiments in meta labeling. But remember, the secondary model is telling us when to trade and when not to trade. So it basically says, oh, your primary model said you should trade. Now I'm looking at, the full equation, and I'm saying, no, it looks like it's, there's a higher probability that you're going to lose money. And so it says, don't take a position. And so that's the one distinction. But yes, you're correct in that it's learning how to use the information better. And that usually comes from maybe you're using something very basic in the primary, and the secondary is able to pick up information that the primary wasn't. And so maybe you use the machine learning model in the primary, let's say in SVM. If you used an SVM with exactly the same features in the secondary model, you're not going to see an information advantage. And so if you wanted to see an information advantage, you'd probably have to change it to, say, a random forest, because a random forest may be able to pick up on relationships that the SVM didn't. And so we might see an information advantage there.
Understood. One more question. So in this particular experiment, with this German powered long only primary model and having meta labels over top of that, what do you recall? Like, what was the balance of the meta labels? Was it split exactly 50-50%, or was there an imbalance?
Sure, I can't remember, but if I remember correctly, it depended on this drift component that we added. I think if this drift component is 0, then so we actually used a dual autoregressive 3 process to show the different experiments, and so you'll see that in the original paper. And so yes, one version of it is that we only used one equation, but in the second experiment that we ran, we used 2 different autoregressive AR3 processes, and they kind of swap randomly. And so we do that to create a data generating process that changes through time. So it has these structural breaks in the data. And so I think it depended on the regime that you were in that we did there, but it was very close to 50% from what I remember. It wasn't like very skewed to the one side. It was, very close to you. It was a great experiment because
there was
you have to
reasonable
exploit
balance.
the
I understood. Okay.
Yeah.
Got it. Thank you. Yeah, that's all I had.
Oh, my pleasure. And I guess one of the things I want to highlight here, the reason we used an AR3 process was because I knew exactly what generated the next day's return, right? We knew it was a combination of RT, T-1, and T-2. Okay, so I didn't have to play around with creating any like complicated feature engineering techniques or do like a principal component analysis on, I don't know, different moving averages and technical indicators and fundamental data. We didn't need to do any of that. We knew exactly what generated the data. So we could like really, peel back how meta-labeling works. All right. And so one of the things you'll read in Advanced in Financial Machine Learning is Lopez de Prado talks about how we're going to do a trade-off between precision and recall. Okay. Recall is going to refer to how many trades we take, and precision is going to refer to, how many of those trades were correct, right? And so we want to take less trades, but have better precision. And when we do that, sometimes we're going to, it's going to improve all our metrics, but that depends on a couple of things. And I'm going to show you that in a second. But when we ran these experiments, what we saw was we took the difference, right? So this is the percentage change in, precision, recall, accuracy, F1, and what we call AUC, which is area under the curve from ROC curves. And what we're seeing here is that, okay, any value below 0 is indicating a drop in performance, and a value above the 0 line is indicating an improved performance. And so we're seeing exactly what Lopez de Prado was saying, was that, yes, we're going to trade off recall for precision, and we're going to see an increase in our F1 score. So the F1 score can be thought of as how well your model performance or your model efficiency. And so what we're seeing is that all the metrics improve. We take less trades, but we're more accurate on the trades we take, and that allows us to build better strategies. Now, one thing I want to tell you is that, you may think to yourself, oh, great, you love meta-labeling. Now you just want to jump into it and apply it to every strategy you've ever built. But don't do that, right? The first step actually is what we call the strategy risk template. So this strategy risk template was first mentioned also in Advances in Financial Machine Learning. I think it's chapter 13. But, I couldn't, I've read that book. I mean, we built ML FinLab. That book was so, built mostly around that textbook. And it only clicked to me when I was writing this paper that this strategy risk template he spoke about in chapter 13 could be applied to meta-labeling. And so what is a strategy risk template? It is an equation and a graph that allows us to determine if applying meta-labeling is going to lead, so how much of a change in precision do we need to have a change in Sharpe ratio, right? And so if we run this report, it will tell us, based on the way your strategy trades, are you likely to have a big change with applying meta-labeling or just a very small performance gain? And so this is something I think somebody in the community should build. It's also something we might build in the future, but it's a really cool idea. So let me just show you here, right? So there's this equation over here. It's a bit of a hairy equation, and it's partly due to the quadratic equation. You'll see that when you start to solve for it. You can see it's figure 15.1. So actually, I think it's from chapter 15 in the textbook. And this equation here tells us, for a given Sharpe ratio, what level of precision do we need? And so this is how it's broken up, but there's different components, right? So there's the Sharpe ratio, there's the precision, there's the number of trades that you take, and then there is the expected payout for a negative outcome. So your expected losses and your expected gains. Now, this chart at the above here is telling us, okay, if we have, symmetric payouts, if our expected loss is as much as our expected gain, that allows us then to plot this in 2 dimensions. And what we're seeing here is that we can see here, okay, for a different number of trades, how does this graph change? How does the steepness of the slope change? And so one of the things we can see is that if you have a primary trading strategy that has a lot of trades, then the impact of a small change in precision will be much greater than if you had very low number of trades. So of course, if you have no trades, your Sharpe ratio is 0. That's this line you see over here. And then you'll see here 25 is this the weakest slope, and then you can see how the slope increases as we increase the number of trades that were taken. And yeah, so we can apply this. I mean, you can use this equation right here. So if you have got a primary strategy and you can say, okay, so I guess the only thing we need from that is what are the number of trades the strategy takes? What is the expected, payout or loss from it? Then we can compute this graph and we can see, will meta labeling add value? And there's a couple of interesting things we see here, right? So one of the things is that the Sharpe ratio increases. So let me read here a little bit. What would be the impact of the Sharpe ratio by increasing the precision at the cost of reducing the number of trades? And so the Sharpe ratio is a function of precision and not accuracy, which is what I was saying earlier. Each strategy is going to have its own risk profile. So for example, the moving average crossover strategy takes a lot of trades, but very few of them actually make money. But when they do make money, those gains are much bigger than the losses that it incurs. And so that's one example. Or maybe in a pairs trading strategy, you'd have lots of winners, but when you lose, that loss is bigger. And so you typically want many trades, as this impacts the steepness of the slope. But Lopez de Prado also notes that when your expected gain is much bigger than your expected loss, meta labeling may also add value. And so in a trend following strategy like the moving average crossover, as long as you can lose many trades, but as long as when you make money it's much bigger, then there's a really good chance that meta labeling can add a lot of value. And so we always want to apply the strategy risk template before we dive into building the secondary model and applying meta labeling. And then just in terms of further research, so I originally presented this in July when the paper first got published. We go through these different parts of meta labeling. We have a primary model. We then, model for the information advantage by passing through the original features. We create a secondary model. We also, want to have, modeling for false positives, so creating features that you think will be indicative of false positives. And then we're going to do probability calibration, which is, our new paper, which is going to come out soon, is going to talk about this. And then we apply position sizing. And so further areas of research that we wanted to do was meta model architectures. This is published already, and we can always do a reading group about this. Probability calibration using position sizing. Papers coming out soon. There's a lot of really cool ideas here. Inverse meta labels. We wrote about this in the second paper that's published. And then the fourth paper that we're working on with Dennis from UCL here in London is about applying meta labeling using ensemble architectures. And so that's further areas of research that we're working on.